Hi everybody, this is Alan. My channel name is Alan Talks FinTech, and today I want to talk to you a little bit about compounding and growing your wealth. Let's get started. So, one of the people I follow a lot on YouTube is Dustin at Jazz Wealth Managers. And I was watching him one day and he said, if you save $5,000 per year between the ages of 25 and 35, and then you stop investing but continue to reinvest and let the money compound, then at age 65 you'll have more money than someone who saved $5,000 a year between the ages of 35 and 65, obviously with the same rate of compounding. So I sat down and tried to find a calculator for this, and I couldn't really find one. So I sat down and I created a spreadsheet to kind of do this calculation and prove what Dustin was saying was really true. So as it turns out, if you do a 7% annual compounding, then the first case, the ages of saving between the ages of 25 and 35, you'll end up with about $600,000 or over. In the second case, between 35 and 65, you'll end up with about 500,000. So let's take a look at the spreadsheet that I created. Okay, everybody, let's take a look at this spreadsheet. So I got it plugged in at 7% rate of return. The amount we would invest every year is $5,000. And then let's start at the worst case, 35, and we go to 65, and then we take the money out after year 65. So first, some information about the spreadsheet. The starting year means you invest money at the beginning of that year, and the ending year means that you let it compound through the end of that year, and then this withdrawal year will be after that year you would take money out. So it's not a perfect setup in terms of years and stuff, but it's just kind of for demonstration purposes and get you the idea of how all this works and the advantage of starting earlier. So let's take a look at this. So as you can see, age 35, you start investing $5,000 a year all the way up through the age of 65, and then after that you start taking money out. You'll have $546,000 compounded at 7% with reinvesting. Now, here's what Dustin was talking about. Let's do this 25 years, and then we'll go through the age of 34, so that would be 10 years. So $602,000. So you'd end up with more money investing 10 years, so this is actually 10 years, than if you started at 35 and went to 65. So that's kind of interesting. So it goes to show you that, you could save 10 years versus this is actually 31 years, and you can end up more money at the end of age of 65 or year 65, and it's just through the power of compounding. So when I saw this, I'm like, what if? So let's try age of 1 and go to age of 2. Interesting. So if I invested 2 years and I let it compound at 7%, 5% each year, then after the age of 65, we'd have $786,000. So that's kind of cool. 2 years, basically $10,000, $786,000. So let's try something a little bit later. Let's go start at age of 10, go through the age of 12. So that'd be about 3 years, $620,000. That's pretty cool. Let's try 16 through the age of 20. So that'd be 5 years. $646,000. So you can see as you go later, you gotta save more years to get in the same ballpark. So as you go up, as you start later, you need to save more. That's the sad thing. So there's all kinds of. It's kind of cool playing around with this spreadsheet. So I started age 1. Wow, now I have $4 million. So anyways, I thought I'd just show you this. And until I actually created this spreadsheet and tried it all out, I didn't realize how little you had to save if you started at a really earlier age. And that's the point of this whole video. Alright, so let's get back to the slides. So here's a quick summary of what I was showing you in the spreadsheet. If you started in your first year and you save for 2 years, $5,000 each year, so a total of $10,000, and you let it compound at a 7% interest rate, and you reinvest that money after each year, then you'll end up with about $786,000. Pretty cool. Now, if you do between the ages of 10 and 12 for 3 years, so $5,000 a year for 3 years, you'll save $15,000. You'll end up with about $620,000. Now, if you do 16 to 20, 5 years, $25,000 total, you end up with $646,000. And then the ages of 25 to 34, so you have 10 years in there, includes all of those years. You'd put $50,000 in, you'd have $602,000. And then, finally, the one that Dustin mentioned was you start saving at age 35. You go all the way up to 65, so if you include year 65, it'd be 31 years. You'd have about $155,000 that you would have put in there. You're saving and reinvesting at 7%. You only end up with $646,000. So when you see the numbers, it's kind of shocking when you see it. It's like, wow, the longer you wait, the more you got to save. And then you still can't catch up with people who saved very little early in their life. So moral of the story is save early. If you're just, you had a new child, start saving. Teenager, save. Or you're early in your career, that's the time to save. And you won't have to put as much money in, and by the time you get to the age of 65, you'll have a lot of money. So here's what you can do with this knowledge. First of all, you got to start early. Earlier you start, the better. So one thing you should do right away when you have kids is start saving into a 529 college savings account. Do that no matter what you do. The other thing you could do, and this goes to the heart of the idea of compounding, is you can open a UGMA account, Universal Gift to Minors Act account, which is a custodial account in your name, but with the social security number of the child, and then you start putting that $5,000 a year into that. And like I said, if you do it in year 1 and year 2, that'll set them up pretty well for the rest of their life. Now, I'm not saying don't stop putting money in there after age of 2. Obviously, the more you put in, the better. But if you just did that in years 1 and 2, you get them off to a really good start. Now, what can happen is when they get to teenage years, then you can maybe start transitioning the money out of that custodial account into a Roth IRA. Once they start having earned income, then up to the max that an IRA allows, you can start shifting some of that money out of that brokerage account into a Roth IRA, also in the child's name. And then that will allow them to have that as a retirement fund as they go forward. Now, the other thing too is when they get to their first jobs, obviously you want them to put money into a 401k. And so you could end up having a Roth IRA and a 401k both once they get to their first jobs when they're in their 20s. The other thing that some people do that I haven't really looked into that much is some people open trust funds. And the advantage of the trust fund is you have more control over the money. You can say when they get money, who gets money, when, all that kind of stuff. The trust has the control of that money. One problem with a custodial account and a Roth IRA in the child's name is once they get to age 18, then they basically gain control over it and they can do whatever they want. And the whole idea of doing all of this is let it compound over, 60 some years, and the longer the better. But sometimes if you give money to a young teenager or a young adult, they might spend that money. So trust fund may be a way for you to have more control over what happens to it so they don't spend it in a way that you hadn't planned. Okay, so savings early in your career allows money to compound, and without compounding it's very, very hard to retire early. So without compounding, if you just saved money, say you maxed out a 401k every year, which right now is $19,000 a year is the max. So you do that over 30 years, you'll have $570,000 without any kind of compounding or return on investment. Now, apply 3% compounding, that $570,000 goes up to $930,000. 8% compounding goes up to $2.3 million. So one of the things to kind of look at with all of this is how much return of investment are you getting? You're going to go safe, get the 3%, or you're going to be aggressive, get the 8% or 7, whatever it is. Obviously, the more you compound, the better it is. But I just wanted to show you, some of the numbers. The higher the compounding rate, the more you'll end up with, after 30 some years. So what most people advise, put the money in a S&P index fund, which will return 5 to 10% every year on average, and you just leave it alone. But most fixed funds, like my company, has a so-called guaranteed fund, and right now it pays back about 3%. And you can move stuff to that money as you get older. You're ending the end of your career, and you're thinking about retiring. But earlier in your career, you should be in an S&P index fund. So the other thing to watch out for index funds, you got to watch out for fees. So a lot of the Vanguard and even Fidelity funds, you can get some no fee or low fee funds. And then also make sure that any dividends or capital gains that you get in these funds are reinvested back in. So that's where the compounding comes in. So there's a couple websites you can look at that's kind of interesting. They have kind of calculators. All right, so let's take a look at this chart from macrotrends.net. One thing I like about it is it has a little slider at the bottom that you can change the years on, and it's basically showing the returns of the S&P index fund over that range of years. So green being in the positive territory, red being in the negative. So one thing I do is I kind of pull it forward. Say we want to start year 2000. Then what you can see is the rate of return in each of these years. So it has pretty good graphics shows you what's in each year. And what you'll notice is that there's a lot more green years than there are red years. But there aren't too many, they're either over 10% usually, or some are not too bad, 11%, 9%, 13. There's a really bad one, 23. This is 2008, 38%. Here's last year, 6%, and then so forth. So far this year we're up 9.42. So this can kind of show you or give you a good indication of what returns on an S&P index fund is. So I just thought I'd share that with you. This is another one I use to look at returns on the S&P 500 index, DQYDJ. One thing I like about it, say I go back to January year 2000, and I say I'm going to this month. Well, we'll say through February, and we can kind of calculate a return. They also have another calculator. If you put actually a certain amount of money in there, you'll calculate your return. So you'll notice over those years, just about 20 years, almost 19, the S&P returned 178% total return with dividends reinvested, and then an annualized return of 5.5%. Now, part of that's because if you remember in that last chart, 2000, 2001, 2002, those years were really bad. So let's change the year. Let's go to 2004. Recalculate it. Now you can see the return is 8.24%. So if you start off with a bad couple years, you're not going to get as much. If you start out with a long term number of years, you get better. So suppose you're about a 65-year-old. So let's go way back. I don't know. Say you go back to 1955. Calculate it. You see over those years, it's about 10.28% over those years up through now. So you can see over a longer period of time, and you can see that with that last chart, there's a lot more green than there are red, but over a shorter period of time, you can run into, like we did with the year 2000, you can run into a couple consecutive years where it's not as good, but say you start in the year 2009, 14% over that period of time. So I just want to show you that. But so the S&P index, it's not a panacea. It's not always great, but in general it's pretty good. All right, so let's go back to the slides. So one thing to think about when you start thinking about compounding, and you start growing wealth for your kids, you start thinking about what are you going to do with your money, and building generational wealth. So a lot of people have been saving it to IRAs and 401ks. They're not doing pensions anymore, and a lot of people go around and say, hey, I wasn't given anything by my parents, so I expect my kids to earn their way. Even kind of Warren Buffett's like that in some ways. So they're not planning to hand down any money. But I think that's kind of a mistake, because what sometimes happens when you have that attitude is you don't teach your kids about finance. They're kind of left to their own. And I think the families that are going to do real well in the future are families that teach their kids about finance and show them how to invest. So I think it's really important, say you start saving early for your kids and then you open a Roth IRA for your kids, you also need to kind of teach them about it. So I think that's important. But, as far as your wealth goes, the parents' wealth, you don't know when you're going to die, so you might as well have a plan for what you're going to do with that money in case you die early and stuff like that. You should set up your beneficiaries and stuff like that and figure out, who it's going to go to and what you want to do with that money. And then, so if you're thinking holistically about this, then you're kind of viewing your wealth as a family asset. You're thinking more about generational wealth. And people who think in those terms are more likely to teach their kids about spending, saving, investing. The kids will do better. Maybe they won't get themselves in deep debt and things like that. And if you are investing for your kids' futures, you can teach them about that, and you're basically building generational wealth. And then potentially, you can see the power of compounding. You can get up in the millions of dollars by compounding. You might be the next rich family. You might end up having kids that have a lot of money, and your family has wealth. So we could all do it. This is America. Go out and build that wealth. All right. So hopefully I helped you a little bit. At the very least, start investing money for your kids. That's what I'd like to see you do. The other thing I'd like to see you do is hit the subscribe button, hit the like button. Come visit my blog. It's alantalksfintech.com. I also have a Twitter feed. It's Alan Talks Fintech without the H on the end. And then I have an Instagram page and Pinterest. So, and I'm starting my affiliate links. I'll post all this in the YouTube video. But, I'd like to hear what you guys think. Post some comments. And until next time, see ya.